So let's start with just a quick rehash of what we know so far. And who wants to tell me what we know so far? Who dares? Balance sheet. So, okay, so what are the two financial statements we've learned so far? Balance sheet and the income statement. And how are they set up as far as together?
So from the income statement, you get net income, which feeds into your balance sheet as an asset.
And so
Everybody knows in QuickBooks, it's called a profit and loss statement.
P&L. They call it a P&L statement sometimes too, right?
Can't find an income statement.
Profit and loss. And right, so I'll put that here too, P&L. And actually, that's a good point. When you, as a manager in a large company, one of the big responsibilities is when you get to the place where you have P&L responsibility for like a division or something. That means you actually have control over the revenues for that division and the expenses and the contribution that division's making to the overall conglomerate or corporation or something. So P&L, you hear that a lot, and it just means profit and loss. Same thing as an income statement. It's a synonym, again. They have lots of those kind of things. So think of balance sheets as bookending a income statement, right? And we talked about this, and sometimes I don't know if it's because it was confusing to me at first that the balance sheets are like a snapshot in time. They're just like at one particular time what the assets are worth, what the debt is worth, and what the income is. Think of it like your bank account in a way, It's just a snapshot in time. You have $100 in there, and then maybe at the end of the year you have $200 or $50, whatever, right? And what happens during that time is what either adds to it or subtracts to it. Now, cash is just one part of the balance sheet, right? And it's the top, it's the most liquid thing on the asset side, right? And we talked about that, right? It's assets and liabilities and equity, right? And what they call the accounting equation is just restating this. Liabilities plus equity equals assets. And these two things are the money sources, basically, right? And they are used to buy assets. And basically, a company buys income-producing assets. Things that are going to generate money in some way, shape, or form. And so that now we have this, right? And this is revenue minus expenses equals net income. And that can be called earnings or profit as well, but net income we'll call it for this. There's two ways to have income-producing assets, right, in a way. One is something that's going to add to the revenues, maybe, or something that's going to add to cost savings. You can think of it either way, right? They're income-producing. And so then, like you said, the net income for the year then goes into, actually no, it goes, right, it goes into the equity, and that's called retained earnings, that flow of whatever's left. And you can also dividend out some. Some companies dividend out, and if you buy stocks on the public markets, a lot of them you look for who has a nice dividend stream. Because whatever you buy the stock for, the price, and whatever the dividend is, that's considered the dividend yield or the percentage. It's almost like interest you're getting, right? Like if a company costs $100 to buy a share, say of IBM or something, and they're dividending out $5 a year in dividend, then you'd have a dividend yield of 5%, right? And that's about what IBM, it might even be 6% now. But that's where, and that's a good deal when you think about it. When you think about it, well, you could do this, or you could put your money in a bank account and make like this much interest, right? It's nice to have. Then you're not even really concerned if the stock goes up or down. You're always making your $5, your 5%, whatever. So that's the net income can be split in those two different ways. But let's just think of it for now, all going into the company. Companies like Google and ones that are growing fast, they don't dividend out anything. It all is into retained earnings. So it makes sense? So this would be like at the end of the year one, say, and this would be during, year two, what happened during that whole year. And then this would be at the end of year two, right? And that's how you would look at look at these. So then we introduced the concept of, and what I'm going to do is, I think we'll watch the 3 videos of Khan. Have you ever watched Sal Khan Academy? Really great stuff. It's free, KAHN, Khan Academy. Tons of kinds of things you can learn. He has mathematics from like first grade all the way up through calculus and differential equations and linear algebra and all kinds of stuff. And then also economics and biology, chemistry, all kinds of things. So it's a great place to go, great resource, a great place to tutor, kids or college people.
Is it on YouTube?
It's its own website platform, but yeah, they're embedded YouTube videos. And if you go on YouTube and just search Khan Academy, which we'll just Google it and I'll show you, and all the videos come up on his YouTube channel as well. Really an impressive guy and an impressive pedagogical tool, thing that you can turn to. It's interesting, when he started it, he had 2 nephews, and he was an investment banker in New York, and his 2 nephews, I forget if they live somewhere, were having trouble with algebra, right? So he started making these little YouTube, little videos on algebra and putting them up on YouTube for his nephews, and got all of these, people watching him and stuff, and he was pretty surprised. And then one time he was going to visit, and he said, okay, I'm coming down, and so we can actually do it in person and all. And they said, no, Uncle Sal, we'd rather watch the videos. It's better for us. And so you can think about, on the video, you can watch it 5 times. You can, go back over pieces that if you were daydreaming for 5 minutes, wait a minute, you got to rewind and stuff like that you can't do in a classroom. So it really is a good learning tool. And you can watch it until you know it, So it actually, that was sort of a surprising, he was one of the first that, sort of was realizing, wow, that, that it was a different environment, a different medium, and actually had some benefits. Plus, anybody could watch it anywhere, right? People in Ghana or in India or somewhere can watch and learn all this kind of stuff. So the concept that we're going to talk about from that is accrual, right? And that's accrual accounting as opposed to cash accounting. We talked about why cash accounting doesn't really work that well unless every single transaction is happening at the same time, because you might get some prepaid things that you're going to do the service later, or you might pay something now and get the service later, or those kind. Or you might sell something and the customer's going to pay you 3 months later. And if it's just cash, all that stuff gets really confusing. So the big thing in accrual accounting is the matching principle, right? And what that is about is, all this is about trying to make things transparent and try to make your books understood by someone who isn't active in your business every day, like your banker or an investor or the taxing authorities, all those kind of people. So the matching principle says, it's based on this, right, that we want to match an expense with a revenue. So when a sale happens, we want to book an expense at the same time. When an expense happens, we want to book that revenue at the same time. Even if the money hasn't come in yet, but it's going to come in later, or the expense has happened, but we haven't paid it yet out of our cash, right? So that's the matching principle, and that is what accrual is about. And that part of accrual, the income statement part of accrual, there's 2 accounts that it generates, right? One is called accounts receivable, and that's the revenue that you booked, but you actually haven't gotten the money yet, right? And then on the expense side, it's called accounts payable. And that's where you've booked the expense, you have the liability or whatever, the obligation, but you haven't cut the check yet or whatever, it hasn't come out of your cash yet. And so depending on if these are high or low or change over time, your revenues could be over and understated and your expenses could be over and understated, right? And that's basically what the cash flow statement, which we're going to talk about later, does. And that sort of goes below the income statement. It starts with net income and then does all the add backs and minuses to adjust for these. and one more type of account. So it's not that much, but it kind of gets confusing to people. But so you have accounts receivable, accounts payable, and they'll show up on here right under cash, right? Because cash, the money comes into your cash. When you sell something, you get cash. Right under there, the next thing usually is you'll have marketable securities too that are just basically places where you're parking cash for a while, so it's not just getting no interest, but you can maybe get some interest in the stock market or bonds or something like that. Something that you could sell tomorrow, like from a Charles Schwab account or something, but in the meantime, you're making some money. Accounts receivable is like the next thing on the balance sheet. And on this side, and then these two things here make up current assets, right? So these are your current assets, stuff that's really current and liquid. And also inventory goes up here sometimes and sometimes, not. And then over here, you have your current liabilities, right? And that is basically your accounts payable. And there's a number of ratios you can do called the current ratio and the quick ratio and things like that, where you're basically saying, do you have enough cash and cash equivalents to cover your payables, right? So you want to have, you put this on top of that, you want to have a number that's sort of, your current, your current ratio or your quick ratio. The quick ratio takes out inventory. The current ratio has all three of these, right? And that makes sense because you can't really, it's hard to change your inventory quickly into something to cover your cash, right? So quick ratio is saying, is there enough cash to cover those payables? So you want a number basically that's greater than 1, right? That you want this number to be bigger than this number as you have your, current assets over your current liabilities. That's these ratios. It's just a quick balance sheet test to say, am I solvent? It's a liquidity test to say, do I have enough money to cover my bills? Any questions so far? Making sense? I'm going pretty fast, but we went through this before. That's why I'm kind of going over it quickly. But stop me anytime, ask me any questions, right? So there's one more account basically that gets, or concept that gets created in accrual. And that is called depreciation. Sometimes it's called amortization, but we'll just call it depreciation. So depreciation is when you spread out the cost of an income-producing asset that you bought over the life of that asset so that it's more clear, it more clearly portrays the use of that asset as an expense over time, right? So say if you bought some computer system and it cost $100,000, Well, you could take, if you just expensed it, right, you would just take that whole $100,000 in 1 year, and then that would really hit your net income pretty hard, right? And it wouldn't be that accurate because you might say, I'm going to use that for 5 years, right? So it would make more sense to take 20 grand of that each year for those 5 years, and then say, this is sort of a more accurate picture of how we're using that asset. And it could be a computer system, it could be a truck, it could be a machine, whatever kind of thing, but something like that. So when you do that, instead of expensing that capital item in the first year, what we do is we capitalize it. We put it on the books as an asset. So we would say, in this case, say it was a computer system. We put, computer system, and it would go on our under our assets as part of our, equipment for 100 grand, right? And then each year we would take 20 of it. So then we'd say minus depreciation, so 20. And so net of depreciation would be 80, after the first year, right? And then we take 20 the next year, and then net of depreciation would be 60, right? And depreciation would go up to 40, right? Until it went down to 0, right? And then we'd have to do some adjustments. Say if we still had some life left, but we carried it for 0, and then we sold it, and we actually sold it for 25 grand, well, then we'd have to put back that money into the system, and it wouldn't come in as revenue. It would come in into the cash flow statement. See, because we're just going to talk about our revenue and expenses up in our income statement or our P&L statement, and all the other stuff's going to come into cash flow, right? The cash flow statement, all those other adjustments. Does that make sense? That's basically, and there's lots of different depreciation schedules. When I say we take 1/5 a year, that's called straight line depreciation, and that's the most sensible one. You just take whatever. If it's a 3-year life, 1/3. If it's a 10-year life, 1/10. There's all these double declining balance and all these other sort of exponential. Where you take a lot of depreciation at first and a little at the end and all that. But we won't worry about those too much. But just know that there are those kind of things. It's called depreciation when it's on a tangible asset. It's called amortization when it's on an intangible asset.
There's a list or a guidance, right, given for which kind of property.
Yeah, and tax gurus are really into that kind of stuff, and it depends. If you have a lot of times people want to accelerate the depreciation, take a lot of it up front. You'd only maybe want to do that if you had a lot of income you were trying to cover. And then you can make your numbers look better. Sometimes you want to really spread it out, and instead of, like we talked about waste management, right? Instead of taking it over 10 years, take it over 20 years, then you're having that expense, and so the other money falls to the bottom line, and then your net income looks bigger. You're sort of artificially inflating it, but that could help your books, help your performance look better. So sometimes people do that. That's really it, I think. And then we'll go through the cash flow statement. And just to give you an idea about what the cash flow statement is, before we go and look at those accrual, these accrual videos. It's a accrual world. So the cash flow statement, we start with net income, and then we're going to do all the adjustments to it to get down to cash. And there's 3 parts of the cash flow statement. 3 parts. So net income is the bottom line of the income statement, right? And net income is the top line of the cash flow statement. They just flow together in a way. You can stack one on top of the other. And so the cash flow statement, I'll just write it over here, starts with net income, and then we're adding back and subtracting changes in AR, changes in AP, changes in depreciation and amortization, those kind of things. And that's called the operations section of the cash flow statement. There's 3 sections of the cash flow statement. Operations, investment, and financing, right? And these all make really good sense, and this is the hardest concept to understand, so it may take a little bit of time to sink in, but we have some time. So the operations, you're doing all these add backs and stuff to adjust to see what was, really hitting cash and not hitting cash in the income statement. Then investment is like this $100,000, right? If we actually, we bought that, right? We paid that money. But we're only expensing the depreciation part. So in the investments here, we would actually say, wait a minute, 100 grand went out the door, at this time. If we sold it after we went down to 0 on the depreciation for 25 grand, we'd actually have a plus 25, it's a minus, right? Plus 25 grand from the sale of, proceeds from assets that were sold. So that's the kind of stuff that happens in the investment section, because it's not showing up in the income section, in the expense section, right?
Do you add and minus in the investment section?
Depending on if you spent it or it was money coming in. Say if you had a truck and you depreciated it down and you sold it for 10 grand, then you'd have to add it in, right? Because it's money that came in. You're not going to put it up here as part of your revenue because it really wasn't a sale of your stuff. It was a sale of some of your equipment that you got proceeds from. So that would go into the cash flow statement down here. And the last part is financing. So this is where, say if you sold 1/3 of your company and raised $2 million in a stock sale, it wouldn't come in as revenue, right? It wasn't a sale of your goods or something. It comes into financing. You do plus $2 million, right? And say if you got money from a loan from the bank, that's where we'd go into this section here, right? Because it's money that hit your cash, but it wasn't like a sale. And when you pay off that loan, we'd go the other way, right? I just paid out of cash, $1 million for a loan, whatever it is, right? So those are the three sections of the cash flow statement, and that's what they do. These two are kind of obvious in a way. This one, the operations, adding back and taking away changes in accounts payable and accounts receivable, that can get a little bit confusing at first, but it's really not if you just think about it. It's just changes in these accounts. That's money that either you booked but didn't come in, or money that you booked and it didn't go out, because you really want to see what's hitting cash. And so now the way that these things all flow together is you have your net income going into retained earnings, right, into equity. And then you have whatever this cash position is here, right? That gets added to what you had in cash here, right? So this cash position is really C1 plus your cash flow statement bottom, so that whoosh, goes into there. And that's how all these things flow together.
When do you do the cash flow? Do you do the cash flow when you're doing your income statement after you've done your you've done your first balance sheet, you do your income statement, you do your cash flow, and then you do your last balance sheet?
Mm-hmm. You can't do your last balance sheet until you know what the cash position is, because that is what drives these numbers in a way. Now, this number and this number won't be the same, right? So you're not actually balancing with those, right? The difference gets made up in the depreciation, the AP, and the AR numbers, and magically then it all balances out. And if it doesn't, then you got to go back to, basically the first thing you do after you do all this stuff, right, is you go and look at your bank statement, or online right at that moment and say, okay, it says we have $1,842.32. This number plus this number better equal that number. That has to the penny equal. Sometimes there's a little rounding if you're 2 pennies off or something, but if you're like 10 grand off or something, you got to go back and go through and see where somewhere you made a mistake, because that's called reconciliation. You reconcile these numbers with your bank statement, and it actually has to be how much you have in the bank is what this number is plus what you had previous. And that's how it works. That's basically the whole deal. So let's take some time and we'll look at those accrual videos to get a better idea, of that, because he steps through it really nicely and slowly. And but I think you already pretty much got it. But these are the points to really hit. This one's pretty easy. Balance sheets are easy if you just think of it like a house, right? This is the appraised value. This is the mortgage. What's left over is homeowner's equity, right? So it's liability. The mortgage and the equity are what fund the asset, the house, right? You might have to put 20% down, then you have a mortgage of 80%, and that equals 100% of this price. Right? And as this price goes up and this goes down, then this can go up. And that's what we all want to do, right, with our homes, is have some equity. And if it doesn't, if this asset goes down in price and this is more than that, then you're underwater, upside down, whatever phrase, you have negative equity. And that happens to companies too. That happens to banks when we have a depression or something. Banks close because their assets are suddenly priced lower than what they owe. Big trouble. Questions? Where's Phantom?
We lost him.
What?
We lost him.
I know, he is truly a phantom tonight. Maybe from the, he might be at one of those president parties or something, President's Day parties, where everybody dresses up like a different president.
Yes. There's such a thing on President's Day?
I hope there is.
There's such a, I hope there is too. I just made it up, but yeah. We could just hope, right?
Next year I'm Teddy Roosevelt.
Okay.
I'm going to play that tab. Wear the fancy.
You got to get some pillows and stuff, yeah.
Yeah, I'll do it. Carry my muzzle loader. Yes.
And Roosevelt, okay.
Yeah.
He was the first conservationist president.
Well, yeah, because he spent a lot of time out west. He was sort of a sickly child or something, and they went outside and outside, and they made a man out of him, and he came back and took over the country.
Is that like the whole like national park thing too?
Pretty impressive guy.
He was part of the building of the Forest Service, building the BLM, Park Service.
He did all that stuff.
And was it the first
shot,
national
too.
parks?
He was shot at a rally.
Really?
Mm-hmm.
Wow.
And survived it.
He did
Attempted assassination.
a adventure trip down the Amazon too, like one of these ones, and almost died. It was like really pretty hair-raising.
So there's an interesting thing about the United States is if you look at how big the national forests are out west, it's because of Roosevelt and Pinchot and those guys that were doing that, because they saw what had happened to the East Coast and how decimated all the forests got,
Yeah.
and that's why there's no national forest really on the East Coast, is because they didn't have any rules. It was unfettered capitalism and destroyed the land. So
Well, and that's a big point of all of this is that, yeah, capitalism is good in some ways as far as motivating people and getting, clearing maybe with markets and supply and demand and all those kind of things. But unregulated capitalism can be a disaster,
what did I,
pollution or just, cutting down all the trees, whatever it is,
I was
just
watching Meet the
really.
Press, and they had somebody on there, Chuck had somebody on there, and the guy said something about like moral capitalists. That's what we need moral capitalists. And I'm like, but that's against what capitalism is in its truest sense.
Right, it's an oxymoron,
Yeah.
All that kind of stuff about ethics and, in business schools they teach, you're supposed to have ethics and all, and then you turn around and, Volkswagens, sneaking their emissions tests or, somebody's,
People that you think are.
Bernie Madoff's taking everybody's money and, doling out the stuff he gets to the new people and, Enron, all these companies are just, cheating and lying and stealing. Or selling us stuff even the ethics of, ethics of tobacco companies or ethics of opioid companies, there's just all kinds of, or big polluters, or extractive industries,